Is the stock market expensive? That's something we've heard a lot over the past really year or so, with the S&P 500 being at a 23 PE or price to earnings ratio on next year's earnings. Victor, what do you think?
Yeah, I mean, we've seen consecutive years of now 20+% returns. We're edging up to where close to a 30% return on the S&P 500 this year. And so this is where you have to get into that conversation. Hey, how high are the prices of these stocks compared to what they should fundamentally be worth? And so what we talk about a lot as analysts, as investors, is that value for price. And so it comes down to the fact of, why does valuation matter? Because to your point, when people say, oh, the stock market's quote unquote expensive, it's not because the dollar cost is high for a share of SPY. It's because they're saying for how much, earnings that these S&P 500 companies are bringing, that dollar amount paying for that amount of earnings is expensive. So that's how we look at when we're talking about valuation and whether something's expensive or cheap in the stock market. It's really a combination of two things, because every equity price comes down to a combination of how many earnings, or maybe cash flow. You could either value something on a cash flow basis or an earnings basis, but for each dollar that you're willing to pay, how much earnings are you bringing? So that's your classic PE ratio, price to earnings ratio. How many dollars for each dollar of earnings per share are you paying? And so then it comes down to, okay, so the function there, the calculus is, hey, okay, so I'm going to pay this dollar amount. Well, how much are investors willing to pay for each dollar of earnings? Now, a lot comes into that piece of it. So you've got those really two fundamental things: the amount in earnings, and then what investors are willing to pay for it. And the amount investors are willing to pay comes down to a combination of things, where when interest rates are higher, investors are willing to pay less because they can get more in fixed income. Or there's, hey, maybe there's more stimulus in the market, whether that's monetary from the Federal Reserve or fiscal from the federal government. If there are more dollars flowing into the market, well, there's more dollars to chase those stocks. So those valuations are going to go up. And then things like sentiment, how are investors feeling? If they're feeling really bullish on the economy and future prospects, they're probably going to be willing to pay more for each share of stock than they would, hey, I don't really feel so good about the market right now. Maybe I'm not going to, offer as much for these shares. And so I want to kind of go through that conversation, but really just kind of boiling it down to what valuation is. It's really that combination of earnings and what investors are willing to pay for it.
Yeah. And so on that 23 PE, where the S&P is right now, that'd take 23 years of earnings at the current rate, which gets us into the growth conversation later, which is a key input to this. But essentially 23 years of this amount of earnings to recoup your investment. Not all of that's paid out directly to you, but essentially that's kind of how it works. And so, that's where these concerns come from of, okay, this is higher than the long-term average, which, there are, reasons for that, but we'll, get into that conversation a little bit more later. But we are on the higher end of historical average. And so that you're essentially paying more for perceivably the same thing. The S&P 500, something important to point out, does reconstitute. The weights of companies change, and the companies in the S&P 500 also change. So over time, it is a moving target. It is a changing product. But, essentially, again, paying a higher PE than normal. So does this make it an expensive market? So that's a big concern there. And as well as, high PEs make it difficult going forwards because, part of your growth, like you mentioned, in the value of your investment is earnings growth. And part of it is multiple expansion commonly. Well, high PE, that multiple expansion can be zero or even negative and work against you, to where even if the earnings on the S&P grow 10% next year, if your multiples expand downwards, you can really be returning half of that.
Right. And I think this is the critical piece of it, going back to, how much are investors willing to pay. Well, you could have, just to kind of simplify things, say the market's at a 20 PE right now and there's zero earnings growth next year. Well, if investors all of a sudden decide they want to pay 22 times, well, that's a 10% increase. So the market just went up 10%. Conversely, you could pull back to an 18 times multiple with no earnings growth. You have a 10% decline in the market. So whenever you're talking about investing at high PEs, that's where the investor concern comes from. Now, I do want to take things kind of from our perspective, saying that we aren't quite as concerned about the PE multiple on the current market and what it is compared to history. Because when we look historically, I mean, 25 years ago, the S&P 500 was fundamentally different in its constitution than it is today. The biggest companies in the world were financials, industrials, healthcare, even some utility companies that just don't grow as fast as the modern constitution, which is your Nvidia's, Microsoft, Meta, Apple, your big tech companies that are growing earnings at a very high rate. Well, as an investor, you're going to be willing to pay more for companies today if you know that their earnings are going to grow substantially over the next 2, 3, 4, 5 years, because you're growing into that valuation. If you're growing at a very slow rate, well, you're only going to be willing to pay so much extra for that earnings growth because it's just not there. So I think when you're talking about today's S&P 500, yes, it is at a higher PE ratio. But what we like to look at is that price to earnings to growth perspective, where you're talking about, hey, how much am I paying in PE to the amount of growth that I have? And a lot of times investors will call that GARP, or growth at a reasonable price, because you're going to be willing to pay a slightly higher PE for growing companies that are growing their earnings fast than those that are just kind of stagnant, that maybe have, good earnings but aren't growing at such a substantial rate like the S&P 500 today.
And something I want to interject in there real quick is that taking a GARP mindset is really kind of, shying away from what we'd consider, or, something that we've talked about before, being a value trap. Is there a lot of great value companies that, might have a really low PE, but that earnings growth is negative? They're former companies that used to be great that are slowly or quickly shrinking into the small cap index, for example. And so your price to earnings will look really good because your price is so much more forward looking than those earnings, that 1 year outlook that you have on those earnings, whereas the price is, counting that growth perspective too.
Right. And I know that you wanted to mention Nvidia for a great example of this, how a company, may have a higher PE than, say, average in the market, but has that earnings growth to really back it up, and it's at its current valuation.
Yeah, exactly. So back onto that GARP perspective is you have Nvidia, the largest company in the S&P, making up about 7.5%, 7% of the index. And so they have a 35 times PE. But that's justified because they just grew their earnings over the past year. I mean, if we look at the previous 12 months versus the prior 12 months, it's about a 3x in earnings. And then, just the past 12 months from start to finish, you're talking well over 100. I mean, they're growing very quickly, and it's not going to take very long for those earnings to catch up to that price that they're demanding right now. And so when you have a company like that taking up such a large percentage of the S&P, that in and of itself will drag up your S&P price to earnings ratio all on its own. But that one company has good underlying economics to it. Taking a step back, not every company in the S&P 500 does have those good financial characteristics that underlay a 35 PE. So this is where we have, we get excited. We have what I'd like to think of as an advantage of being stock pickers, of being more choosy than just buying the S&P as a whole. We can look at individual companies, say, hey, Nvidia backs up this PE. They're worth 35 times earnings. But, say Apple, they're a huge company too. They have a very similar PE, but their growth is in the high single, low double digits right now. And comparing them apples to apples to Nvidia, it's not as compelling of a story. Obviously Apple has some other advantages going for it, the staying power, the market share that they command. And so other things that can drive that price to earnings multiple, but they don't have that earnings growth that some other companies do.
Right. I mean, this goes back to kind of the top of the episode. I mean, there are a lot of things that drive what people are willing to pay for a certain level of earnings. I mean, like you said, a substantial market that's consistent, something like Apple, people are going to be willing to pay a little bit more for because it's a cash flow generating company. But like you said, the growth isn't there. And I think it's interesting to talk about companies like Nvidia, like Apple, because they are part of the Magnificent Seven, which we've discussed a lot as the primary growth drivers of the 2023 market run. And those companies have influenced the overall PE multiple on the S&P 500 because they're some of the 7 largest companies in the index. And so if you strip those out, you're looking at a market that's somewhere around 19 times forward earnings rather than somewhere around 23 over the broader market. And this is just really reinforcing that whole idea that you have to look at the individual companies within the index. We aren't index investors. We invest in individual equities. And it's important to look at the PE that you're paying on these individual stocks, what their growth expectations are, why investors are willing to pay a certain amount per earnings on these individual stocks, because it is a market of stocks, not a stock market. And so it's important whenever you're talking about being an active investor, investing in individual equities, really diving into that broader index, because when people are talking about, oh, the market's expensive right now, we don't know how much the S&P is going to go up next year. Well, that's less of a concern from our perspective, because when you are looking at the individual companies, there are still a lot of areas where we see value today where, hey, maybe these companies that we're looking at, well, the earnings growth justifies a higher PE, or maybe they are at a lower PE than the overall market, and there is some value there.
Yeah, and you mentioned the Magnificent Seven. Going towards that, 2023 was a really bad market to stock pick in. It made sense because the whole top of the index was what was appreciating so quickly that if you're indexed, you're partaking in all of those gains. If you're stock picking, it's a lot harder to have such strong overweights all at the very top. So it was a more difficult market for stock picking. We have been fans of Nvidia for a very long time, so that was a great thing. 2024 has the beginning of it still Magnificent Seven. Tesla and a couple others were underperforming at the beginning and stuff. And then as the year progressed, it became more and more of a stock picker's environment, which sets us up for 2025 being a very exciting time to, deep dive into this. The whole S&P multiple is higher, but we can take a look at those underlying individual companies and really focus in there and drive value that way.
And I think that's the interesting piece about this whole thing. You saw the Magnificent Seven just outperforming on an earnings growth perspective so substantially over 2022, then 2023, and now in 2024, still outperforming the broader market. But 2025, that gap is really shrinking substantially. So it's going to be exciting to see what we expect is a, broadening out of the market rally, seeing that extend to smaller companies that are going to really benefit from some of the what we expect will be deregulation, interest rate cuts of next year. And so I think the market in and of itself, yes, the S&P 500 index, because of the way it's constituted, might be expensive, but generally, I think there's a lot of areas of value that investors can find still today.
Yeah, and speaking of those smaller companies, the S&P 600 is a really interesting place right now. So the S&P 600, what it is a subset of the Russell 2000, which these are small cap companies. It's entirely different than the S&P 500. So don't make the mistake of, a lot of people think it's the S&P 500 plus 100 others. No, they're entirely small cap companies. But unlike the Russell 2000, they, pare that back a little bit into 600 companies who fulfill the requirements to be in the S&P 500, excluding the market cap or the total size of the company. So these are profitable companies is the big thing. So all profitable small cap companies trading closer to an 18 times multiple. So if you're concerned about valuations, there's a lot of room in that S&P 600 to find some really good companies trading at really good prices.
Right. Not to mention the whole fact that I think the economic backdrop for those is pretty exciting right now. And then, of course, if you're stacking some kind of these significant megatrends on top of it, AI, some of the healthcare trends, some of the trends with financials, I think there's a lot of exciting areas of the market to get into that you can still consider value.
Yeah, exactly. It's a exciting time going forward.
Definitely. Hunter, thanks for the podcast today.
Yeah, thanks.